There is a strange moment that happens right after a Federal Reserve chairman tells Congress that inflation is improving, and it is this the moment he refuses to celebrate. That is exactly what happened this week. The government had just reported that consumer prices fell by 0.4% from May to June, the sharpest monthly drop in years, driven largely by cheaper gasoline. Reporters were ready to write the victory headline. And then Kevin Warsh, in his first appearance before Congress as the new chairman of the Federal Reserve, said something that should have been the biggest financial story of the week, and somehow wasn't. He said there might be some who look at this morning's data and think the fight against inflation is over. Then he said, plainly, that is not his view. In one sentence, the man who controls the cost of every mortgage, every credit card, every loan in the country, told the room he still doesn't trust the data everyone else was ready to celebrate. And if you own gold, if you own silver, or if you have been thinking about it, that sentence matters more than almost anything else that happened in markets this month. By the end of this video, you will understand exactly why. To understand why one sentence from a Fed chairman can move the price of a precious metal thousands of miles away, you have to understand something about how gold and silver actually work. Their price reflects what people believe about the value of money itself. When confidence in a currency is high, gold usually sits quietly in the background. When confidence cracks even slightly, gold and silver start to move, because they are among the only assets on Earth that do not depend on anyone's promise to pay you back. No government, no bank, no institution stands between you and a bar of gold in your hand. That is why, throughout history, gold has surged during the exact moments when trust in central banks and currencies has been tested. We have seen this pattern before, and it is worth walking through, because history is the only reliable map we have for what might come next. In the 1970s, the United States faced a brutal combination of high inflation and slow growth, a condition economists call stagflation. The Federal Reserve Chairman at the time, Paul Volcker, made the extremely unpopular decision to raise interest rates aggressively, even as it caused a recession, because he believed that letting inflation run loose would do far more damage in the long run. Gold during that decade went from roughly $35 an ounce to over $600 an ounce at its peak, an increase most investors at the time thought was unthinkable. The lesson from that era was simple. When a central bank loses control of inflation, or is even suspected of losing control, hard assets become the place people run to. Fast forward to the 2008 financial crisis, and you get a very different lesson, but one that connects directly to the man now running the Fed. Kevin Warsh was actually a Federal Reserve governor during that crisis. He has said publicly that he still carries what he calls the scars from 2008. He watched the Fed turn to massive asset purchases, a policy known as quantitative easing, to try to stabilize a financial system that was seizing up in real time. Warsh initially supported those emergency measures, but he grew uneasy as the Fed kept expanding them, and he eventually resigned from the board partly over concerns about how far that policy was going. That detail matters because of what it tells you about how this man thinks. He watched the consequences of printing enormous amounts of money up close and walked away from the institution partly because he thought it had gone too far. Now, more than a decade later, he is the one in charge. There is also a symbolic detail from this week's hearing worth sitting with for a moment, because it says something about the weight Warsh feels in this role. In his opening remarks, he reflected on the long line of Fed chairs who came before him and singled out Alan Greenspan, who passed away last month after a full century of life. Warsh noted that Greenspan appeared before Congress more than 200 times over his career, a reminder that the relationship between a Fed chairman and Capitol Hill is not a single event. It is a decades-long negotiation over trust. Warsh is only at the very beginning of that negotiation. Everything he says in these early appearances is being weighed not just for what it means today, but for what kind of chairman it suggests he intends to be for years to come. That brings us to this week, and to why his testimony landed so differently than a routine hearing usually does. Warsh appeared before the House Financial Services Committee on Tuesday and the Senate Banking Committee on Wednesday, delivering the Fed's twice-yearly required report to Congress. On paper, this is one of the most predictable events in the entire financial calendar. In practice, this one carried unusual weight because it was Warsh's very first time facing lawmakers since taking the job, and because the economic backdrop right now is anything but simple. Here is the picture he was walking into. Inflation, measured year over year, had just cooled to 3.5%, down from 4.2% the month before. That sounds like good news, and in isolation it is. But the Fed's target is 2%, meaning even this improved number is still well above where the central bank wants it to be. At the same time, the Fed's benchmark interest rate has been sitting at 3.75% to 3.5% since December, unchanged through multiple meetings. While markets have been pricing in real uncertainty about whether the Fed's next move, expected at their meeting on July 28th and 29th, will be a rate hike, a pause, or something else entirely. Layer on top of that a renewed military conflict involving Iran, which has pushed oil prices back upward after they had briefly calmed down, and you have a Fed chairman trying to read an economy that is sending contradictory signals in almost every direction at once. This is the exact kind of environment where a single phrase from a Fed chair gets picked apart word by traders, analysts, and, if you know where to look, by people quietly buying physical gold and silver. And Warsh gave them plenty to pick apart. Beyond his refusal to declare victory on inflation, he made a point of resurrecting a practice that had quietly gone out of fashion at the Fed for years, tracking and reporting on the size of the money supply. Under the previous chair, the size of the money supply was treated as largely irrelevant to setting policy. Warsh disagrees. He said he holds what he called an old-fashioned view, that monetary policy has something to do with money itself. He was careful to say he does not want to return to an era where the Fed explicitly targets the money supply as its main policy tool. But the fact that he is choosing to measure it publicly and report on it to Congress tells you where his instincts sit. Small signals like that from a new Fed chair have a way of turning into major policy shifts a year or two later. There is a psychological dimension to all of this that is worth pausing on, because markets are not just calculators, they are made up of people, and people respond to uncertainty in predictable ways. Behavioral finance research has long shown that investors tend to overreact to ambiguous signals precisely because ambiguity is uncomfortable, and precious metals often become the release valve for that discomfort. Imagine two fictional investors watching the exact same testimony. One reads Warsh's caution as prudent, responsible leadership, exactly what you'd want from a central banker after living through 2008. The other reads that same caution as evidence the Fed itself isn't confident inflation is truly under control, and decides to quietly increase a position in physical gold as insurance. Neither investor is wrong. That is precisely why moments like this create such powerful, sustained interest in hard assets, because they don't require universal agreement on what happens next, only enough uncertainty for a meaningful number of people to want protection just in case. Warsh's testimony also touched on another theme that connects to this same undercurrent of uncertainty: the enormous build-out in artificial intelligence infrastructure now reshaping the American economy. He described it as the most striking feature of the economy right now, and acknowledged that nobody, including the Fed, fully knows how large its economic impact will ultimately be. He even suggested that before long, what people currently call AI investment will simply be called investment, folded into the ordinary rhythm of the economy. That may sound unrelated to gold and silver at first, but it isn't. Massive, uncertain shifts in productivity and capital spending are exactly the kind of wild card that make forecasting inflation and interest rates harder, not easier. And every time forecasting gets harder, the case for holding an asset that doesn't depend on anyone's forecast being right gets a little bit stronger. Then there is the question that may end up mattering more than anything about inflation data at all, and that is the question of independence. Warsh takes over the Fed at an extraordinary moment in its history. His predecessor faced an aggressive and sustained pressure campaign from the White House to cut interest rates, including attempts to remove a sitting Fed governor from the board, a case that ultimately went all the way to the Supreme Court. During Warsh's testimony, one lawmaker asked him directly whether he works for the president. Warsh's answer was short. "We're an independent central bank," he said. Another member of Congress asked how he would respond if the president publicly pressured him to take a different course than what the economic data supported. Warsh's response was equally direct. His commitment, he said, is to follow the law, follow the data, and follow the Fed's very best judgment. Whether or not you find that reassuring, The fact that a Fed chairman has to answer that question at all on the record in a formal congressional hearing is itself remarkable. Central bank independence is one of those things markets simply assume exists right up until the moment they start to wonder if it doesn't. And once investors start wondering, gold tends to notice before almost anything else does. Before we go further, if you're finding this breakdown useful, this is a good moment to hit like on this video and subscribe to the channel, because we track exactly this kind of intersection between Fed policy, precious metals, and the broader economy every single week, and you will not want to miss what comes out of that July 28th meeting. Drop a comment too, and tell me whether you think Warsh holds the line on rates or caves to political pressure, because the arguments on both sides right now are actually pretty strong. Now let's talk about what all of this actually means for gold and silver in practical terms, because up to this point we have been building the case, and it is time to connect it to the actual market. Gold has had an extraordinary run over the past year, trading up more than 20% compared to where it stood 12 months ago. It surged to an all-time high above $5,000 an ounce earlier this year, before pulling back significantly, and it now trades in a range around $4,000 an ounce. Silver has moved even more dramatically in percentage terms, and is currently sitting more than 50% below its own January peak. That kind of divergence has pushed the ratio between the two metals, meaning how many ounces of silver it takes to buy 1 ounce of gold, to a level near the top of its 50-year historical range. Historically, when that ratio gets stretched this wide, it has often marked a point where silver becomes historically cheap relative to gold, a signal some investors watch closely for exactly that reason. Why has silver lagged so much even while gold has held onto a strong year-over-year gain? The evidence suggests it comes down to silver's dual identity. Unlike gold, which is almost purely a monetary and store of value asset, silver is also a heavily used industrial metal consumed in solar panel manufacturing, electronics, and a wide range of technology applications. When markets fear that higher interest rates will slow economic growth, that industrial demand outlook weakens, and silver gets pulled down even in moments when gold, driven purely by its monetary role, is holding steady. At the same time, publicly available industry data shows the global silver market has now run a supply deficit for 6 consecutive years, with total above-ground stockpiles drawn down by an amount roughly equivalent to 9 months of global mine production since 2021. That is a structural supply story that does not simply disappear because of one interest rate decision. Many analysts who track the physical metals markets believe that combination, a historically stretched valuation against gold, alongside a genuine multi-year supply shortfall, is worth watching closely in the months ahead. Put those pieces next to each other and the picture gets clearer. A brand new Fed chairman who witnessed the 2008 crisis firsthand and grew skeptical of the very tools used to fight it. That same chairman explicitly refusing to declare inflation defeated even after a genuinely encouraging report, a quiet revival of old-fashioned monetary measures most of his predecessors ignored, an open question about whether the Fed can truly act independently of political pressure, playing out in real time in front of Congress and the Supreme Court. And over the whole picture, a live military conflict pushing energy prices upward at the exact moment the Fed is trying to figure out whether inflation is actually cooling or just catching its breath before rising again. None of this guarantees any particular outcome. Nobody, not Warsh, not the analysts covering him, not this video, can tell you with certainty what happens at the July 28th meeting, or where gold and silver will trade 6 months from now. What history does suggest again and again, across the 1970s, across 2008, and across every period where central bank credibility has come into question, is that these are precisely the moments when interest in gold and silver as a hedge tends to accelerate. Some economists believe the current setup, cooling but still elevated inflation, a Fed chairman openly skeptical of premature victory laps, and geopolitical risk actively pushing energy costs higher, represents one of the more textbook backdrops for continued strength in precious metals that we've seen in years. Others believe if inflation genuinely continues cooling from here, much of this concern fades quickly. Both of those views are being argued right now by serious people, and the data over the next few weeks, starting with that July 28th Fed decision, will start to reveal which argument is winning. It also helps to zoom out for a moment And remember that the Fed is not a single voice, even when one man sits in the chairman's seat. Other Fed officials have already been filling the silence Warsh has deliberately left behind. One Fed governor warned this week that another hot inflation reading could force the committee to consider raising rates in the near term. Meanwhile, the president of the Federal Reserve Bank of New York offered a very different rid, suggesting that if core inflation holds at a mild, steady pace for the rest of the year, the Fed could avoid a hike altogether and simply hold rates where they are. That kind of public disagreement among the people who actually vote on interest rates isn't dysfunction. It's a real split inside the committee walking into one of the more consequential meetings of the year. For anyone watching gold and silver, a divided Fed is arguably more important than a unified one, because it means the outcome on July 29th is not a foregone conclusion, and markets tend to move hardest precisely when outcomes are not foregone conclusions. Kevin Warsh had every opportunity this week to say the inflation fight was won. He chose not to. That single, quiet refusal probably tells you more about where this economy is headed than any headline number from this month's CPI report. The biggest economic signals rarely show up as loud announcements. They show up as one careful sentence from someone who gets paid to choose his words well, and this week, Warsh chose his very carefully. If this breakdown helped you see the bigger picture behind the headlines, subscribe to the channel, because we'll be back the moment that July 28th decision lands, breaking down exactly what it means for the dollar, for the markets, and for anyone holding gold and silver right now.